Market open live stream. It's been quite a while since we've done one of these, and futures is somewhat trying to recover a little bit right now. There's a lot of fear about the fact that we saw the CEO ones in Hong Kong get COVID, and a lot of concerns about COVID cases rising in China. You see mobility data slowing down substantially, and so this is leading to fears, especially at companies like Tesla. That oh no, here we go, they're going to shut down Shanghai again. So obviously, COVID exploding and COVID cases rising in China while mobility is going down, air travel's plummeting. You've got subway usage plummeting. These are not things that lead to a lot of optimism for the market. China has also had some pretty nice rallies over the last year here, but unfortunately, those seem to get sold every single time. Like we've had this sort of Chinese optimism multiple times before. I'll show you a chart right here. Look at this particular chart. This shows you sort of in these circled blue, orange, and yellow areas here, how we have little rallies and then they plummet. The rallies just regularly get sold. Now you had a very nice one that lasted there for a while, obviously, that started in 2022 there. But look at how it's transitioned, how we're lower than where we were in the pandemic. I want to say if you look at the MSCI China index, you're down somewhere around 60% over the last 2 years in China. It's been a really, really painful trade to be in China, and all of the fear now about mobility plummeting is not helping whatsoever. Mobility, obviously, a very big leading indicator for consumerism and retail sales. Chinese consumerism in the toilet. Expectedly, though, so because, see, one of the things that we remember here and we think about a lot here in America is that when the housing market slows down, you get people spending less money. And so that's one of the things that we're expecting to happen in America is that, okay, well, when the housing market actually continues its downtrend that it's on, how is that going to affect stocks? How is that going to affect earnings? A lot of folks really concerned that we're going to see a lot of negative earnings next year. We'll see, but I will tell you some good news because I like some good news. Okay, some good news. Look at this. Finally, how long has it been, folks? How long has it been? Finally, Nespresso coming out potentially with these, well, not potentially, I mean, it looks like they actually will, but coming out with paper pods. This is a game changer. Now, I have used this thing very seldomly because, I got a Nespresso coffee machine in here. I would actually probably have to buy a different one. That sucks. See, that's how they always get you. You have to buy another machine now. But anyway, usually you have these little aluminum kind of little packet thingies, but then they have like a liner inside that gets all nasty and you can't really recycle it. So kind of wasteful to use little pods. So paper pods will be really neat to see. Anyway, that's that. So let's take a look at, I want to show you the break even here. Let's see here. Break even. The break even for the 5-year has been a big deal. And it's been something that I've been tracking for, oh gosh, I mean, certainly over this last year here as we've been worried about the Fed and inflation. And I want to look at the latest moves here with you. We've kind of flattened over here, which is nice because we want to be going in the down direction, right? Jerome Powell was pissed that this section was happening. And, we really peaked after Jerome Powell talked dirty to us. And he pushed these expectations right back down, which really, that's his job. People wonder like, oh, what's Jerome Powell's job? Why is he got to be so mean to to the markets? His job is to talk down inflation expectations. So when this chart goes down, he succeeds. He's winning. What is this? Google Cloud considers scrapping sales commissions based on deal values. That sounds terrible. That sounds absolutely terrible, Google. Wait a minute. Let's think that through for a moment. Okay. So when Google, and they've been emailing, okay, this is actually kind of interesting. And it just makes me wonder if there's like dysfunction at Google, which there probably is. But I've gotten quite a few emails from this person over at Google, and they're like, hey, why don't you upgrade for your businesses to the next, G admin suite? and which we use, for all the different companies. And I'm like, okay, gee, well, what benefits would I get? They're emailing me trying to upsell me to get to the next Google package, and they list the benefits, and I'm like, dude, I already have those benefits. And the person's like, oh, I'm sorry, you're right, you're already paying for the best package we have. And I'm like, come on, man, y'all a little dysfunctional here. But anyway, this is an interesting update just now coming across here, that Google considers scrapping sales commissions based on deal values. What that's kind of implying is that these sales reps who are trying to sell longer term contracts, whether they're 12-month contracts or 24-month contracts, or even 6-month contracts, whatever, they're having trouble selling them at a larger rate. And so usually commissions are assigned as a percentage of the contract value. So let's say you sell a 10-year contract, commissions can be fat on that sucker, right? You sell a 10-year contract at $50,000 and you get a 10% commission, that's a $5,000 check. But if now you're doing a 6-month contract at, I don't know, 6-month contract at, I don't know, $5,000 a year, $2,500, call it $3,000. Well, now all of a sudden you're getting a $300 check, and Google's probably like, man, these contracts ain't worth it. We should just replace you with a bot. That's a little bit of how I'm reading into this. So I think Google killing potentially commissions on deals because of what they say, because of deal values, is a way of saying their margin is suffering, right? So margin is suffering. That's a sign that they're actually losing PP. Remember, PP is really important. PP stands for pricing power, and we want our PP to go up because you want to invest it generally, in my opinion, not personalized financial advice, just, I have to be careful with what I say because, a licensed financial advisor, I just want to make sure it's clear. It's not personalized to you. But I think my opinion is that it's a good idea to invest in companies that have pricing power. And this is actually a potential sign that Google's losing some of its pricing power. Now, we've watched Google lose its pricing power as their ads have become less, not only profitable, but you've seen less ad spending. That's no surprise. But now you're potentially seeing that in the services sectors as well. And that's actually good for the Fed, just bad for the stock market when you start seeing services suffer. Now, Google doesn't really seem to actually be caring much about this news. It's sitting at $97 right now. It's off its lows of $83. It's certainly performing better than Tesla in the pre-market today. Tesla is just like a straight down arrow. I had to remove the Fibonacci's because they just don't work. It's just kidding. There they are. But you could see that obviously Tesla just continues to break lower. It's kind of sad. Let's just go ahead and hide that again. But the trend here doesn't look very pretty. In fact, actually, let's bring that back. Let's delete all here. Let's see if we can draw just a nasty trend line here. Let's go from where we are now. What do we got? Oh, wow. See that the trend has slowed down a little bit, the downtrend. You can see it was very, very aggressive up here, right? Your slope over here was substantially higher than what you have here. In fact, you just, come on, Weeble. Here we go. So here you've got about a 43-degree slope, and now you're at pain of somewhere around 15 to 17%. So you've certainly slowed that crush over at Tesla, but it's still. Let's just put it this way: the trend right now is not your friend if you're long Tesla. Hey, but at least you have misery company of DWAC over here. DWAC down 2.5%, which is really interesting that DWAC's down 2.5% because, this weekend, Donald Trump kind of snubbed Elon Musk. Elon Musk reinstated, Donald Trump based on a poll that Elon Musk ran. And then, of course, anybody who is upset about this poll just immediately suggests, come on, Elon, how could you just use a poll when maybe 80% of your followers are bots? It's a rigged poll. So now you, in a weird way, you have people on the left suggesting that polls are rigged because they don't want to see Donald Trump come back. But anyway, Elon Musk has been tweeting some, images of temptation that Donald Trump might be facing. Like, for example, this one. There's Donald Trump trying to behave himself, I suppose. Anyway, kind of interesting. I'm surprised that Dwack is actually down on Donald Trump kind of snubbing coming back to Twitter, because you think that'd be good for Truth Social, but still down a couple percent. Then again, it's not a company I personally would invest in because I think they haven't, I want to see real financials. The good news is they've actually created the company. They've actually started running advertisements. You could probably sell MyPillow advertisements all day long on Truth Social, but money-losing businesses are generally not your friend in a recession. So it'd be really interesting how things go with Dwack. Although I don't think that Dwack right now is trading on any sort of fundamentals. We should also talk about Disney. Let's just take a brief moment here and listen into what Jim Cramer's got to say, just for a moment. Yeah. All right. So if sound too low on that one, no Kramer. Oh, really? You couldn't hear any of the Kramer? Uh-oh. Hold on. I know what that means. Hold on. Aha. My audio is probably a million times better right now. Thank you for that. Good catch. Yeah, my audio should be substantially better now. And you should hear about 5 seconds of Jim Cramer right now.
For sure. It matters. It matters, especially in Hollywood. But that said, all right, I sat down with Chase.
Okay, so it should work now. Thank you. I appreciate all of Yahoo or channel members who chat here. Let me just say this. I want to talk a little bit about Disney. So I was just at Disney World in Florida, specifically Epcot. And I ran into some subscribers who worked at Disney. And what was really funny is before this whole Bob and Bob transition happened, I was talking to employees there who are also subscribers. Shout out to you. Thank you, by the way. And they were telling me about essentially how frustrated they were that in parks, they are the profitable part of the business in parks and experiences, and that Bob Chapek is basically throwing the profitable part of the business into the unprofitable business of streaming, and that Chapek has this obsession with chasing Netflix, and Netflix is going to start doing ads on Netflix. Okay, then fine, we'll start doing ads on Disney Plus, and then have the lower tier subscription offer. Now, Disney Plus is a pretty good service, I think. Yesterday, I was watching on my way home from the airport. I was watching Zombies 3 with Jack, and the app is phenomenal. The Disney Plus app is really, really good. But there is definitely, or has been, a lot of frustration that I've seen from employees about how streaming cannibalizes profits at Disney. And because the company is becoming less profitable and is missing expectations, now there are layoffs. And the people on the profitable side are like, what the hell? Like, why are we getting laid off? Why are we lumped together here? So some frustrations there. The board yesterday announced, just as I was landing, the board yesterday announced that Bob Iger is coming back for a 2-month contract. I'm sorry, a 2-year contract. Bob Iger is 71 years old. He was the CEO for Disney for 15 years. There's been some bitterness between Bob and Bob. Lauren and I, before we heard about this, as we were walking around Epcot and one of the Disney resorts we were staying at, we were walking around, and it's so ironic that Bob Iger's back, because I look at Lauren and I'm like, you see that light right there? And it was like a lantern by a bridge, and it had 3 light bulbs in it, and one of the light bulbs was broken. And I go, you think old Bob would let that light bulb be broken? And Lauren's like, there's no way old Bob would let that fly. New Bob's messing up. And I told Lauren when we landed, oh my gosh, new Bob just lost his job. She's like, oh my gosh, it was the light bulb. So kind of weird timing. But anyway, there was tension between them when Bob Chapek took over. He's been in his position for 11 months, and they haven't really talked. Anytime you have individuals like this not talking, there's the potential for resentment to build behind the scenes. And it looks like Bob Iger, the original guy, has been talking with the board and probably sold them a better vision than what Bob Chapek was able to do. The don't say gay bill, that whole debacle that Disney went through, that certainly didn't help Bob Chapek. So, some say he was too optimistic. Some say he was too focused on cutting costs. Bob Iger, the first guy, he was the one who led the acquisitions of C21, Century 21 Fox, Pixel, Marvel. He's got some pretty good like street cred over at Disney. So I think any hardship at Disney is just bad news for Chapek, and I think that's why he got the axe. But it's really interesting. Mickey Mouse is a Meet Kevin subscriber. Yeah. So anyway, the Disney thing is quite interesting. Disney's actually moving decently on this news. Let me see this more. Earlier it was up like, let's say it was up 6% or something. Oh, it's up 9% right now. Look at that. So Disney presently up 9% on old Bob coming back. While at the same time, you've got the NASDAQ down about 0.5%. Break even stable again. But again, these rumors about more lockdowns in China and pain in China, certainly not going to help a company like Tesla. I also think Elon Musk really's got to chill out a little bit with his aggressiveness on Twitter. He's like over the weekend, and I know some people believe it, okay? And it's fine. And when I say some people, I mean there could be a lot. Look, 80% of you, hey, maybe even me, might believe that the New York Times is fake news. But come on, Elon, no. He's on Twitter claiming that the New York Times are liars and fake news. And I'm like, no, this is how you alienate advertisers. Just shut your mouth. Be a CEO. Oh, well, what are you going to do? Most of the market, at least on our sheet here, red. As you can see, you've got Polestar. Wow, Polestar's. No, these are the warrants. Okay, I was going to say Polestar's not trading for $1. So those are just the warrants. Never mind. I'm just going to remove those. So Disney up 9.2%. But otherwise, you've got Pain. Oh, Carvana. Carvana, it was one of those, along with Shift, that about like 18 months ago, when the used car shortage started, we're like, you can't be in car sellers when there's a used car shortage. That's when I sold Shift. And it makes sense. Like these companies, kind of like EXPI in real estate or Redfin or Zillow, they make money when you have lots of volume. It's not so much the spread. The spread matters, right? Like the spread is the difference between what you buy something for and what you sell it for. That's great. But generally, these sorts of platforms, these websites, they make money based off of how much money or how many transactions occur. When transactions go down, profit goes down. That's why Redfin's in the toilet, Zillow's, pained. You got some problems. So Carvana's not getting any favors in the market right now. Carvana's got some oopsie doopsies. And again, the used car shortage isn't helping, but now that used car shortage has transitioned into a used car bubble pop where you kind of have prices plummeting on used cars and people are like, I'm in no rush to buy. It'll be cheaper next month. Kind of interesting. And it'll also be interesting to see how much used car prices plummeting weighs on new car sales. So we'll see. Steve here says, call out the BS. I'm tired of fake news. Yeah, and that's fine. I guess you just have to ask, is there a potential risk to the CEO of SpaceX, now Twitter, and Tesla, Neuralink? Is there a risk to that person, being a little bit extreme about their opinions, or maybe shouldn't say extreme, being vocal about their opinions? Is that a risk? Yeah, it is. It's something that, and the reason it's a risk is really for shareholder value, right? Because institutions have to justify why they trust in management. And let's say you have some really wealthy Democrats who are invested in a hedge fund, and that hedge fund invests in Tesla. And those wealthy people are like, why the F are you investing in that guy? That guy's, lost his marbles, and that puts pressure on the hedge fund to sell. So politics is a really powerful game. It's quite interesting. All right. So I think people buying a used car don't have the luxury of waiting a month or two to buy. They need a car. Well, sure, some percentage. That's always going to be true, right? There's going to be a group of people who have to buy a car no matter what, and then there are discretionary purchasers who maybe they've had a used car for 7 years. They're like, I don't need to upgrade, but I might. Let's take a listen. I want to hear what this JPM dude's saying. Let's listen in for a moment.
Sector and security selection, frankly, with the right manager selection, that it makes sense to be an active manager right now in a way that it perhaps did not over the last few years.
Michael, what about in credit? You were talking about how private credit has seen perhaps an outsized number of defaults. How are we sure that the default cycle isn't going to be that deep in the public markets? How much conviction do you have around that?
I actually think credit is in a decent spot over the longer term. It's just sort of over the next 3 or 6 months, 9 months, as the earnings recession takes hold and all of these hikes start to, be felt within the economy, that they go through a rough patch. But on the whole, public credit markets are actually pretty healthy. I mean, if you stress interest rates, if you stress earnings down pretty hard, they still hold up reasonably well from a historical basis. So I'm not expecting a huge default rate here. A lot of the excesses have been wrung out of the markets over the last several years between the global financial crisis, followed by the energy crisis of 15, 16, and then, of course, COVID. And so I think default rates are likely to remain relatively muted. Maybe
I'm going to pull back here. I wouldn't disagree. I don't know that we're going to see a really heavy default style recession. I think the recession is going to take longer than we all think it will, which is painful. But I don't necessarily see this insanity of defaults, whether it's in real estate or companies, with the exception, of course, of the crypto space, which some argue that in the crypto space, the tightening we're seeing there is an example of the Fed tightening. And the bankruptcies we're seeing there is an example of Fed tightening actually taking effect, which I'll have a video coming out in about 35 minutes on the Grayscale Bitcoin Trust. So you can take a peek at that. Somebody else makes this counter argument here, which is a fair counter argument. You could look at it the other way. Republican hedge fund saying, I like him, let's buy. Yeah, I mean, usually it's not so much how it works, just solely because, sure, that could happen, but solely because, hedge funds are trying to think about performance, right? And they're like, well, crap. If 50% of left-leaning managers are like, no, I don't want to buy Elon Musk's Twitter or Tesla or whatever because he's too extreme. Well, then even the ones who are agreeing with Elon are like, oh yeah, okay, that's going to make for a volatile stock. Let's be a little bit more careful. How are they still running Fortune favors the brave ads? You got to be kidding me. Crypto.com still running Fortune favors the ads, or favors the brave ads. It's remarkable. Anyway. All right, so we've got about 6 minutes to the bell. Yields turning red now. They were slightly green earlier, but slightly red now. 10-year Treasury yield down to 3.777. All right, what do we got here? Commercial real estate transactions have fallen off a cliff in recent months as interest rates have climbed and economic uncertainty has mounted. Well, yeah, that doesn't really surprise me. That why? I want somebody in the comments, please let me know why the hell would you buy real estate right now? It makes 0 sense. 0 cents. Now, what's funny is I read the comments. I probably shouldn't, but I was reading the comments, and some people are like, Kevin's pitching his Zero to Millionaire real estate course. This is the worst time to invest in real estate. And it's like, okay, let's bisect this. Yes, I agree. It's a bad time to invest in real estate right now. But guess what that means? It's the best time, probably, to get educated, to get ready to buy in real estate. So, maybe I got to be a little bit more clear about how important that is, right? It's like people are like obviously I'm starting the real estate startup House Hack, and some people are like, oh, House Hack, how could you possibly invest in real estate now? That's a terrible investment. It's like, we're not. You raise money so that when the market bottoms, you can go shopping for real estate. I don't know. Sometimes I think people pay like 5% attention and then they leave like a comment and then they leave. Fortunately, I think that's the minority. Anyway, oil down under $85 for the first time since the end of September. That's quite interesting. But it looks like Brent is actually bobbing around now. It's at $86. So it was briefly under 85 there. You've actually got WTI oil down to 78. And a lot of this is driven by China. COVID fears again. So we'll see what happens. Yeah, well, I would be careful. Investment real estate is actually doing well here in New Orleans. Yeah, just be careful because the trend right now, not your friend. Let's see. Redfin Data Center. Let's go look at New Orleans. Still another Fortune favors the brave ad. I cannot, or bold ad, whatever. I can't believe that crap. So let's see here. All right. So this is price drops everywhere. Let's just see if we can see New Orleans. New Orleans. There we go. New Orleans. All right. So this is your level of price drops, which is obviously skyrocketed. You're at over 8% listings with price drops. It's quite a bit, certainly more than historic norms here. New prices actually trying to move up here. But what about sale prices? Sale prices, I mean, you're not doing you're right. You're not doing terribly. 305, 306 was kind of your top. 279 now. So what is that? 306, 279 is the new number divided by the old number gets you. I mean, you did drop about 9%. But that doesn't mean you still can't get some cash flows. So well, that's cool. That's good. Again, trend not necessarily your friend here, but that's all right. Woo! All right. It looks like oil is also falling on a new OPEC report that production is increasing. That's interesting. I'd buy a house now because F it, my rent is insane. Yeah, you're right. You're right. Got to stop reading the comments. Don't let it affect your mood. Looking for a purple day. Interesting. Fortune favors bankruptcy. That's a good one. Toll Brothers in Vegas just slashed their prices by 15%. Vegas is one of those markets that, and I've got some great connections in Vegas. Some wonderful people out there, but Vegas is one of those markets, including Florida, that got devastated in 2008. It was just one of those markets that people really went in to speculate on. And that was problematic when you had a lot of spec in those areas. They really had a lot more pain. Okay, Tesla's probably about to make a year low at the opening bell here, coming in at probably 175.81. By the way, I want to invite you to New York, December 9th. Stay tuned for more details, but we're going to do a meetup December 9th, right around 4 p.m. by the New York Stock Exchange, between 4 and 4:30, somewhere on there. So it'll be kind of cool. Anyway, let's go ahead and listen in to the opening bell. We haven't done this in a while together, so cheers, because this is coffee, of course.
I didn't know. And David, that last quarter, That was a defeat. That was a defeat. For...
You said it, and you predicted it, and you called for it, and it happened. There is the opening bell. And you can take a look at the real-time exchange back at our headquarters.
Oh, this is all getting on China. You know, I'm getting tired.
Keep in mind, the more you see this sort of the entire market moving together, and this is an interesting concept. Like, you really have to think about what I'm saying on this one. The more the market moves together in one direction, the more likely that direction is down. The more you have certain sectors moving up and some sectors moving down, so sort of like a divergence, the more the market tends to actually move up. It's a really weird thing. Just kind of like this green candlestick at Tesla. The dip buying happening is weird. You know, oh my gosh, we're going to the moon, baby. Look at those candlesticks. Oh, we just recovered a whole 0.5%. Oh, pump it, baby. Anyway, I'm really getting made fun of for Tesla right now because I said that Tesla is recession resilient. I don't want you to think that I have like a mental problem in saying that I still think that's true. I think that the majority of the suffering for Tesla stock has been the result of A, Elon selling, B, Elon going nuts on Twitter saying stupid shit, and 3, the premise that he will continue to sell Tesla to prop up Twitter. Okay, that's why I think you have pain here. Because EPS is going to, we expect, do extremely well next year. As other companies cut their earnings, Tesla earnings should explode next year. Should. So I think the original thesis is intact. It's just really muddied by Twitter. Like, any money you've lost on Tesla this year has gone to propping up Twitter. And if you didn't invest in Twitter, then you just gave that to people who were investing in Twitter. Something just to keep in mind. A lot of action there on that candlestick today. Anyway, let's look at Disney over here, bobbing around. That's a knee slapper. Disney stock is bobbing around. Up about 8.5%. How bad do you think that CEO feels right now? Like the guy who got fired, right? The new guy. Like, imagine getting fired and then the stock you got fired from rallies the day after you get fired. Like, that's just got to be the biggest middle finger of your life. Like, that guy, if he's watching this live stream, dude, like, take some shots of tequila or something, okay? It's okay. It doesn't mean you have a problem. Well, I mean, you have some problems, but it doesn't mean you're having a bad day, okay? Anyway, so look at this. Occidental Petroleum down 4%, moving right down there with the oil market. Marathon Oil moving down with the oil market as well. Roku, AMC. How's AMC doing? AMC's at $7.37. How's that APE? Everyone got so mad at me when I said sell it at $8. Oh God, it's $1.32. It's almost, has it gone under $1 yet? No, it went to $1.25. Oh, I'm such an asshole for having said sell it at $8. Sorry, I ain't living that one down. I got so much hate. That buying pressure, by the way, on Tesla did not last. Tesla, ooh, God, oh, Tesla now down almost 3.5%. Some really juicy red candlesticks just plummeting. I mean, this is what poverty feels like. Okay, that's an insult to poverty. But anyway, DWAC down about 5%. All right, interesting day. Carvana's obviously getting wrecked. NEO, Matterport. Gosh, Matterport down another 4%. I'm actually skeptical. So I went through the Matterport earnings report, and I said this to course members in the course member live stream, which we'll be doing after this live stream. We'll be going into the course member live stream. We talked about, Matterport potentially having some big numbers because of iPhone users coming in for the iPhone app, but I thought that was potentially a lot of one-time movement. I'm not as optimistic about the near term for Matterport as I am for them about the long term. long term more so, but I'm not in Matterport. So Goldman predicting 2023 going to be worse than 2022. Yeah, Goldman can go suck it. Them and their FUD. Yeah. Steve says, I took Michael Saylor's advice and remortgaged my house to buy Bitcoin. My interest rate went from 2.5% to 6%, and my Bitcoin went from 30 to 16. Buy gold. You know, gold's actually been popping off a little bit because of the dollar starting to falter slightly. And so as the dollar falters, relatively, gold looks more appreciable. Let's listen into Bloomberg for a moment.
Pessimistic and doomsday driven. It's likely a sign we are bottoming out. I am pleased to say Sylvia joins us now. So how strong is that conviction that you feel like, all right, people are so gloomy, so doomy? That's a screaming buy signal.
Hi, Lisa. So I don't think that it's necessarily a screaming buy signal in terms of a short-term, turnaround and major profit opportunity. But I do think that the market is going to kind of stay where it is. And even with the most bearish analysts that you just referenced, Mike Wilson and Goldman Sachs, talking about 4,000, that means that we get range-bound volatility probably between now and then. So you're going to get these bursts and perhaps these short-term opportunities. You'll get these pullbacks, but the market is unlikely to sort of fall, further out for the next year. What I think in terms of this market is that it's a great opportunity to dollar cost average in for those investors who have time horizons beyond 2023, because we talked about all the things that have.
Okay, I hate to do this, but can I put into context who this person is? Now I get it. This is the danger of having an ETF. I get it. I really get it. But there are two problems here. Problem number one is that's the wrong screen. Problem number one is this is that ETF or the company, I believe, Defiance Digital. They have an ETF called NFTZ, so like NFTs. The sucker's down from like $24 when it launched to $5.23. And its net asset value, I believe, if I'm reading this correctly, is $5.25 million. So very, 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 very low. All right. I mean, like, I get it. Things are down. But, dude, an NFT ETF? I don't know, man. It's not the bet that I would be making. All right.
Promised fiscal year 24 would be that year.
But what happens if it just changes?
We still don't know the ultimate profit.
But what happens if it just says, listen, we're not going to run for just willy-nilly growth. We're going to charge more. We're going to make it so it's children-friendly.
Right. They already have raised price. They do have the ad tier that's just begun.
Right. The ad tier could be very good.
It could be
more of a Netflix model. You got the theme parks. How about if he says, you're going to make fun of me? And you know what? I don't care because I was right last week. So go ahead. How about saying that the department that Chapek ran and knew so well was the one that should have expanded? In the same way that network that we work for, Comcast, they should be expanding theme parks.
So, okay, that argument right there from Jim Cramer is actually really smart. Disney makes a crap load of money at the theme parks. Disney cruises are like the most expensive cruises that exist, next to like a Ritz-Carlton cruise, which you could go on for like $7,000 to $25,000. Hashtag not sponsored. Who knows? Ritz-Carlton could go bankrupt. Anyway, so that's not a bad idea, is expanding the parks, because that's when you get people to buy stuff they don't need. That's when they spend like $20 on a soda bottle that they ain't going to use again in their lives. Or, $25 for a baseball cap. I don't know. It's like the margins on the stuff they sell at the parks is so high. And people are spending more than ever before, about 50% more per cap, per person. It's remarkable. So I'm surprised they're spending so much time on Disney. Yeah, need a Disney in Texas. I mean, what if they did like, I don't know, smaller theme parks or more roller coasters? I don't know. I was when I was at Epcot, and I'm like, man, I wish I was at Islands of Adventure so I can actually go have some fun. They also, another thing they got to do is they got to figure out the lines. Dear Disney, nobody wants to go to Epcot and wait 30 minutes in line at every country's food booth just to try the damn food. That's dumb. The lines are way too freaking long. Or like sell a freaking fast pass. Like, hey, the Japanese hot dog, not that they're selling hot dogs, but the Japanese hot dog is $5 if you want to wait in 30-minute line, or it's $10 if you want to get it now. Okay. I don't know. Taylor Swift should do that too. You want to get your ticket now? It's 5 times the cost. Do you want to wait in the Ticketmaster queue? All right, it's $80. I mean, like, I'd rather pay the 5x and then not have to deal with the scalpers and all the bull crap and the time. Again, not everybody can. Sometimes you just have to pay with your time. That's what happens when there are shortages. When there are shortages, you pay with your time. You pay in other ways. That's economics 101. But golly, if I ever suggest that Taylor Swift raise her prices, do I get bitched at on Twitter or in the comments? Oh my gosh, the Swifties. I feel like I'm a little bit of a Swiftie too. Lauren's definitely a Swiftie. But raise the damn price or have more concerts, which, I mean, she has announced it, but it's just a freaking disaster. Yeah, I saw that $94,000 tickets for Taylor Swift. Yeah, it's insane. When do you think people will spend less money? Yeah, that's actually a really good question. So one of the things you're seeing trend-wise right now is you're seeing credit card spending explode. So the Federal Reserve just released new data on this just last week. And credit card spending is now back on trend with pre-pandemic levels. So it just skyrocketed up. And household debt is increasing. Household savings are decreasing. And while they're still there and robust, there's this belief that consumers are on mostly borrowed time. I believe that. When do I think that ends? Probably next year, especially if housing values continue to trend down. I think people are going to go, crap, this is lasting longer, than we thought it would. This sucks. We need to cut back. And that's scary, because then it's like, okay, well, now EPS are really going to get hit. I hear. Stop. I can't read that out loud. You mean supply and demand curve is applicable in everyday life? Imagine that. Yeah. So, wow, look at that. Google actually going positive after this talk about potentially cutting commissions for their sales. Now, one of the things you have to remember about Google is there's a lot of pressure right now that Google cut jobs. Actually, across the board in tech, jobs need to get cut is the thesis. And one of the things to know, and this sounds so brutal, I remember saying it during the pandemic, but it's true. One of the things to remember is that, yes, there is a 60% off coupon code linked down below that expires Friday. It's the biggest coupon code we've had. And, you get lifetime access to the program. So, wrong line here. One of the things to remember is that during recessions, companies actually become generally substantially more efficient because they do cut the fat. It's actually necessary. Like it's kind of like a hurricane going through an area and blowing away all the crap, all the old stuff. It's a way to get rid of the slush, so to speak. And that's not saying I want people to lose their jobs or people to die in hurricanes, right? But it's a very natural process. So the biggest thing that you want to do in a recession is survive. Figure out how can you make more money and then survive. That's the biggest deal. Speaking of surviving, I appreciate you hanging out with me for the Market Open live stream. I don't know. You could leave me a comment to let me know if you enjoyed it. I have to go to the course member live stream and somehow make myself another coffee within the next 60 seconds. So I will see you all later. I don't know, maybe for the close. But anyway, enjoy your open and coffee. I mean, whatever's in your mug. Bye.